there's nothing fundamentally wrong with the asset or the market, but they just don't have the cash to turn the units. And so all of a sudden you could be in a situation where 50 units are vacant, not because there aren't people who want to move into them, but because you don't have the $5,000 per apartment to renovate them. And that can create a distressed environment and kind of create a snowball that sponsors who don't have access to cash can run into problems.
I sense that 2024 will be the year, right? Where finally the sellers tap and or they rate caps are just unsustainable, right? They've capped and the NOI is going backwards, right? So talk about DLP strategic advantage with the housing fund to buy, existing deals that people might be hurting on and capture that and reposition those assets at a really good price and basis.
Yeah, for us and our strategy, there's a couple different ways things could benefit us and how they play out. So I'll first start just saying, I think what has surprised a lot of people is, a lot of people, you hear a lot in the news about all the maturing bridge loans that are out there that are going to come due and how that's going to create all this distress because, people are going from really low rates to higher rates and a lot of cases higher leverage than they could get today for the reasons you just said. But I think a lot of lenders, especially banks, have smartened up this cycle compared to that 2010 kind of time frame, in that most banks are very quick to give more time, to give extensions, to give more time to work things out. They don't want to have to start foreclosing and taking properties back. They don't want the regulatory challenges that would come up from that. So as long as the borrower is continuing to make their payments, which is not always the case, right? That's where some of the distress is. But as long as they have the ability to keep making their payments and are communicative to lenders, we're seeing most lenders are willing to give more time. But not every borrower is because they're struggling from a cash standpoint, right? Which, I always say the only reason companies go out of business is they run out of oxygen, which is cash, right? And so for a lot of sponsors, a lot of syndicators today, their investors are saying, hey, we're not giving you any more money because you're not generating cash flow, you're not performing. So they don't have access to cash to fund a lot of cases the negative cash flow they may have if they're in a floating rate loan, as an example. And just simple, I'll give you a simple example. If you own a 200 unit apartment community, and even if you're in a market where rents are going up, demand is strong, occupancy is strong, delinquency is low. If you don't have the cash to turn your units, if you can't afford when a tenant moves out to come in and put new flooring down and paint it and so forth, well, then you can't rent it. And we're seeing a lot of cases where sponsors, there's nothing fundamentally wrong with the asset or the market, but they just don't have the cash to turn the units. And so all of a sudden you could be in a situation where 50 units are vacant, not because there aren't people who want to move into them, but because you don't have the $5,000 per apartment to renovate them. And that can create a distressed environment and kind of create a snowball that sponsors who don't have access to cash can run into problems. And that's where we can step in and when somebody's doesn't have the ability to execute, they're out of cash, and find distressed opportunities like you're saying. But then the other side for us, let's say somebody has a 75% loan to value mortgage. Let's say the property's performing great, but they have a lender who won't give them more time, and they have to now refinance, and they're going to get a 60% new loan in this rate environment. What do they do to come up with that difference between the 75% of their current loan and the 60% of the new loan? That 15% gap, on a $50 million property, that's $7.5 million. Where do they come up with that $7.5 million? That's where we can come in. And a lot of our investments in the housing fund, as an example, we are investing in pref equity. And I would call that scenario I just described rescue capital, where there's nothing wrong with the property, there's nothing wrong with the sponsor, but there's just a gap in the capital stack. And we can come in there and make that $7.5 million investment that's currently debt. So we think about it, debt level risk, but get equity level returns. So we come into that $50 million property where they have, say, 12.5 million of equity in it, and now they need another 7.5 million of equity. Well, we'll put in that 7.5 million of equity. They're 12.5 million subordinate to us. We get all the cash flow first. We get all our money back plus a mid-teen IRR before they get any money back. So we insulate ourselves on an already well-performing asset and a good sponsor, right? Those kind of scenarios are what DLP does a lot of. And it's a win for us. It's a win for our investors, but it's also a huge win for that sponsor to not be forced to sell a property when values are lower, to not be forced into a illiquidity event and go into technical default on their mortgage, right? To avoid any challenges and fill that gap and be able to continue to drive value and own that asset until the market's stronger.